This year's tax refund tells you almost nothing about whether you're winning or losing. You could get a refund this year and still be on track to overpay hundreds of thousands of dollars in taxes over your lifetime. Here's why most tax strategies are focused on the wrong thing and what the informed are doing instead.
This video is for educational purposes only. Always consult professionals before making legal, tax, and investment decisions. Here's how most people measure their taxes. If they get a refund, it was a good year. If they had to write a check, it was a bad year. But neither of those tells you anything about what really matters, which is your lifetime tax bill. Because here's what happens. Your CPA, and they're doing their job, is focused on minimizing what you owe this year. That's what they're trained to do. That's what you're paying them to do. But what if minimizing this year's tax bill is actually increasing the total taxes your family pays over the next 10, 20, or 30 years? That's the question nobody is asking.
So let's talk about what we mean by lifetime income tax bill. Most people have spent decades putting money into 401ks and IRAs and deferred annuities, and the whole pitch was defer the taxes now, pay them later when you're lower tax bracket. And these made sense when it was first explained to you. The problem is it assumes a few things that may not be true. It assumes rates, tax rates, will be the same or lower when you retire. It assumes that your income will drop enough to matter. And it assumes you'll be filing the same way, yes, married filing jointly, for example, for the rest of your life, which we know won't be the case. Any one of those assumptions could be really wrong. And if they are, that tax-deferred account isn't a gift. It's a bill that keeps getting bigger every year.
So here's the part most people miss. There's a partner in your retirement account. His name is Uncle Sam. He let you defer the taxes, but he didn't forgive them. He's going to tell you what his share is in the year you take the money out, at whatever rate he decides. So you've spent 30 years building a balance, and you don't actually know what percentage of it is yours. That's a deal you made, and most people never think about it that way.
Tax rates go up, your IRA spendable balance goes down.
Essentially, yeah.
So here's where it gets interesting. We believe, and this is our professional opinion, that taxes are on sale right now. We're running record deficits. We owe tens of trillions of dollars of national debt, and we're compounding that at a couple trillion extra a year. And at some point, tax rates are going to have to rise just for the budget expectations. They have before. You may not remember, but in the 80s, the top tax rate was 70%. That's not that long ago. It's within our lifetime. Now, does that mean rates are definitely going up? Well, nobody's got a crystal ball, but the math is the math. And if you believe rates could go higher, even modestly higher, then the question you have to ask yourself is, why would I wait to pay taxes at a rate I can't control when I could just pay them now at a rate I know what it is? That's the shift from annual minimization to lifetime optimization. And for most people, since we're in historically low rates, any taxes are going to pay this year are going to be lower than they would have when they were working.
So let me give you a concrete example of how this works. Think of the tax brackets like buckets. The first bucket fills up at the lowest rate. The next bucket costs more, and the next one costs more than that. So here's the misconception. A lot of people say, I don't want to earn more money because it'll throw me into a higher bracket. That's not how it works. Only the dollars that spill into the next bracket gets taxed at the higher rate, not everything underneath. So if you go over by $2,000, just that $2,000 gets taxed at the higher rate. Everything below it stays exactly where it was. If you're wondering why your advisor never walked you through this, subscribe. This is a kind of strategy you should have heard about years ago, and there's more where this came from.
Now, here's where it gets tactical. If you're retired or even close to being retired and your income has dropped from what it used to be, you might be sitting in even a lower bracket than you've been in decades. Most people look at that and think, great, my taxes are low, I don't owe a lot of money, and they leave it alone. But there is the missed opportunity because those brackets have room in them. And if you don't use that room, it's gone. You can't go back and fill last year's tax bracket. So the question becomes, what can you move into those lower tax brackets while the window's still open?
And the answer for a lot of families is a Roth conversion. So here's the concept. You take money out of your traditional IRA, which is tax deferred, and you move it into a Roth IRA, which grows tax-free. Yes, you pay taxes on the conversion, but you're paying at today's rates. In today's lower brackets. And once that money is in the Roth, it grows tax-free. You take it out tax-free, you leave it to the kids, they receive it tax-free. The trade-off is real. It costs you something today, but the math over 10, 20, 30 years can be dramatic, especially if tax rates go up.
Let me tell you a story that drives this home. There's a married couple that we've been working on Roth conversions for the last 8 or 10 years. And we've been diligently converting. Last year, suddenly and unexpectedly, his wife passed. Tragically, in fact. And what we're able to do in the final year of the big tax brackets, because they were married and filing jointly, we converted the last bit of the IRA. It was all completed. He was just in the other day, and he said, I am so appreciative for what you did because my tax problems are all but gone. His IRMAA problems are behind him. He's got several $1 million, and it's really just the interest and the dividends and the capital gains that he's going to pay tax on. And provided we manage it properly, we'll keep him in the first or second IRMAA bracket.
So someday single tax problem solved. Yeah.
But it was solved 8 or 10 years ago. I mean, the start of the solution, it was a long project. And I said to him, did you ever think that first year we talked about doing it that you'd ever get done? And he said, no, I didn't.
Yeah. It's unfortunate how it happened, but
we didn't have any control over that. We controlled what we could control.
That's a scenario most people don't see coming. When your spouse passes away, the tax bracket don't just change. They get cut in half. Standard deduction, sliced in half. The Medicare surcharge thresholds also get cut in half. Every bucket you've been filling as a married couple, it shrinks. And if you've been deferring everything into your IRA for decades, your surviving spouse is going to be forced to take distributions at rates that are dramatically higher than when you paid them together.
Now, here's another story that, coming from home. Our dad passed away in 2019, and our mom became a single taxpayer in 2020. Her tax bill on roughly the same amount of income in 2020 nearly doubled. The amount of money she had to pay the government was twice as much in 2020 as it was in 2019. Unfortunately, our dad planned for it. He had done a lot of the work ahead of time, but had he not, this would have been a 10-year issue. We would have never completed it, or we would have had to pay tax at a much higher rate. That's what we mean by thinking in decades rather than in Aprils.
Now, there's one more thing we need to cover because it catches people completely off guard. Called IRMAA, Income-Related Monthly Adjustment Amount. And what it means is this. If your income in retirement crosses certain thresholds, the government charges you more for your Medicare. Not a little more, significantly more. And here's the twist. There's a 2-year look back. So income decisions you make at 63 affect what you pay for Medicare at 65.
This is one of those things that most people don't know about till it shows up in the mail. You get the nasty gram from Social Security in early December, and by then it's too late to do anything about it for that year. A woman came to us several years ago, and it was right after the law was enacted. And she said, what is this charge for my Medicare? She had sold a bunch of stock that she had inherited and it's been in the family for years, and she didn't want the risk anymore. And I had to tell her something strange. I didn't know what it was at first. It wasn't well publicized. And for people that pay attention to taxes and have tax training all the time, I think it's mind-boggling that we were never even aware of it. But once you understand it, it becomes another reason to be strategic about when and how you take income. So things like Roth conversions, charitable giving, the timing of capital gains, all of this plays into whether you trigger that surcharge. It doesn't happen by accident, and you're not going to solve it by accident either.
So let's bring this together. The question isn't, how do I pay less tax this April? The question is, how does my family pay the least amount of tax over our lifetime? And the tools are there. You have Roth conversions while the brackets are low, filling lower brackets before they expire, planning ahead for the someday single scenario, and being aware of the Medicare surcharges before they hit. None of this is a loophole, and it's not illegal. These are strategies built into the tax code, but they only work if someone's looking at your full picture and coordinating all the pieces.
We believe there are 2 tax codes. There's one for the informed and there's one for the uninformed. The difference isn't income. The difference isn't net worth. It's whether somebody has walked you through the questions you didn't know to ask.
So if you're sitting there thinking, nobody's ever explained it to me this way, or if you're wondering what your lifetime tax bill actually looks like and whether there's still time to change it, we'd be happy to talk. Click the link below and please schedule a conversation. Because investing is the easy part, building the tax strategy around it, that's the hard part.
And here's something we're thinking about. A lot of families we work with are already giving to charity. What they don't realize is that how you give, not just how much, can be one of the most powerful tax strategies in your entire plan. There are ways to give the same amount to the same causes, but keep tens of thousands of dollars more for your family. The next video walks you through exactly how that works. Click here and watch.